Greetings, everybody. My name is Don Miller, and I am the Chief Investment Officer for PivotPoint Advisors. And I'd like to welcome you to our first video briefing, which I plan on doing from time to time to supplement the weekly text and chart analyses that you've been seeing in the briefing room tab on the PivotPoint site. And hopefully you've found that useful. So what we're going to do here from time to time is supplement that, personalize it a little bit, maybe make it a little bit easier for you to understand, continue our mission of full transparency, basically, in terms of sharing with you what we're thinking, what we're doing, how we're acting in your portfolios. In this day and age of investment management, it's critically important to us that we maintain a constant flow of communication and full transparency. So we're going to start that today. And I want to kick it off with, first of all, talking a little bit about how we go about structuring your portfolios, talk a little bit about the risk profile, and then we'll move on to what the market's doing right now. Essentially, what we do is we work on identifying where the market is in its cycle. And like many things in life, and as John has pointed out through this site, the market moves in waves or cycles. It moves in longer-term waves, maybe a yearly or a monthly wave, and it also moves in shorter-term impulse waves on, let's say, a daily or a weekly basis. And it's our job basically to, through a series of tools, identify where the market is and then match that with your particular risk profile, your tolerance for risk, your level of aggression, your ability to withstand short-term losses to capture larger-term moves, and that sort of thing. So that, by the way, is why it's very important, if you haven't had a chance to complete your risk profile, that you please do so and forward that to us. You can find that form in the Forms tab on the website, and if you can please complete that and email it or fax it back to us, that would be appreciated. What that does is assures us that we're able to manage your portfolio at an optimal level based on your tolerance for risk. If you don't do that, you essentially get lumped into more of a default category, which may not be in your best interest. So if you haven't done it yet, please do so. So that's what we do. We align the market cycles with your tolerance for risk and level of aggression. In terms of what we use for investment vehicles, we try to keep things very simple. We use a series of exchange-traded funds, or ETFs for short. And essentially what that allows us to do is to buy into groups of assets on a very simple and low-cost basis. For example, the S&P 500, emerging markets, and even in the case of some of the bond funds, we're able to use ETFs. Now, one of the things I mentioned last week in the text briefing was a change, for example, that we're making in terms of the bond ETFs. Many of you may have seen us use a series of 2 or 3 different funds in the past. And essentially what we did is a few weeks ago completed an analysis in terms of identifying whether we were indeed getting the diversification impact that we were expecting, and compared that to an already diversified bond fund. And what we found out was that the performance over both a short and a long-term basis, the difference in performance between the two choices, between multiple funds and a single aggregated exchange-traded fund, was nominal. It was almost zero. So what we've done, for example, is that we've shifted any bond holdings from the 3 series to a single aggregated fund. And what this will do is a few things. First of all, it simplifies things. You see one fund basically for bonds on your statements versus 3. It allows us to be more nimble in terms of getting in and out of equity and bond positions. And it also minimizes costs to the extent that there are commission charges associated with trading multiple funds, for example. So we can reduce that. Speaking of commissions, by the way, we work very hard at using, wherever possible, funds that have 0 commissions. We are not interested in churning commissions. We don't get anything from it. You shouldn't be paying it. And so wherever possible, and this is a little bit dependent upon which broker you're using, but wherever possible, we are trading funds and investing in funds that have 0 commissions or very low commissions. And again, in doing so, in consolidating on the bond side, for example, we can cut that either to 0 or from 3 sets of commissions down to 1. So that's what we're doing on the bond side. We also use the S&P 500, as I mentioned, and right now we're using emerging markets as well as an equity alternative where we believe that it's appropriate to do so. So that's a little bit about how we're structuring your portfolios and what we're doing at this end. The intent is to keep it simple. The intent is to allow us to use our expertise in identifying where we are in the market cycles and not churning our time, spending our time needlessly on so much diversification where you're really gaining zero benefit and simply matching it with your risk profile. Now, in terms of where we are in the market, it's obviously been a challenging period over the past few weeks that we've discussed lately. We've been trying very diligently to position portfolios to benefit from further gains. We've been in a consolidation pattern for the past couple of weeks, and the bull cycles that we've been talking about now for a while have remained intact, but the momentum has been dying, and so the price has just been flipping back and forth. You see the Dow up 200 points, down 200 points. It's been doing this, for the past couple of weeks because the market just gets so extended. Markets don't go straight up. They don't go to infinity as they don't go to zero. So the markets got way ahead of themselves by all historical precedent. We were very, very cautious in stepping into equity positions at recent highs, and what we were doing is as that price was coming down and testing some key supports, we were scaling people into positions as we were getting price improvement to try to benefit from a break back to the upside if in fact that's what happened. What's happened though over the past week, of course, is that the momentum not only had really continued to stall, but we actually broke down through a key channel support, and I'll refer you to the charts in the current week's briefing. And so what that allowed us to do is even though we had been scaling into positions at good price levels with the intent on capturing more upside, the minute that the premise for that series of trades disappeared and we broke through some supports, we began scaling out of cash, or scaling out of positions and getting back into cash. And actually we started doing that a little bit before Thursday's massive drop in some cases. We saw some weakening, and we started putting a plan in place to start decreasing the exposure to equities. So many of you will see a fairly dramatic shift, short-term shift in your portfolio holdings back into more cash at this point. We believe it's so critically important to safeguard you against drops where the market is potentially changing cycles. We do not believe in keeping people fully invested in a bull market or in an equity market. Regardless of the cycle, we want to try to align you with the cycles that are in play. And so we've made a fairly dramatic shift this week on a temporary basis to get you back into cash. We're still holding some bonds. We're still holding some equity positions. But we're going to reevaluate that as this week goes on, and we're going to see what the market does and make decisions accordingly. It costs people virtually nothing, either zero commissions or very small commissions, to get back into cash, and when it's appropriate to get back into a position that we will be able to do so. That's one of the major things that separates us from the traditional investment management side that believes you ought to be always fully invested in equities, some percent anyway, depending upon or no matter what the market cycle may be. And we've been able to certainly safeguard assets during periods of decline, and you're seeing a little bit of that right now. It's a little bit of a juggling act right now, but we're going to wait for a little bit more market data, reassess, and we'll keep you posted in terms of what we think. So that hopefully helps you understand what we're doing. Any questions or comments or feedback on the video, on the briefings, or what we're doing with your accounts, please contact John. You can reach us at info@pivotpointadvisors.net, and we'll maintain the stream of communication. So I hope you found this helpful. We'll be doing more of these. Have a great week. Thank you.